There is a number nobody in Washington wants to say out loud, 200, as in $200 per barrel for oil. And the reason nobody wants to say it is because once you run the math on what $200 oil does to the American economy, the conversation stops being about whether the United States can defeat Iran militarily and starts being about whether the United States can survive the economic cost of trying. What I am going to walk you through today is not a prediction that oil will hit $200. What I am showing you is the economic logic of why Iran's strategy is designed to push oil to that number, why that number creates more damage to America than to Iran, and why this asymmetry means the side getting bombed might actually be winning. As of mid-March 2026, Brent crude oil is trading between $110 and $120 per barrel, up from roughly $65 before Operation Epic Fury began on February 28th, a 70% increase in 2 weeks. The cause is simple. The Strait of Hormuz is closed. 20% of global oil supply, approximately 20 million barrels per day, is offline. Tanker traffic through the strait has dropped to near zero. Every major oil importing economy is scrambling for alternative supplies that do not exist at sufficient scale. But $120 is not the ceiling. It is the floor of what comes next if this conflict extends. The global oil market operates on thin margins between supply and demand. In normal conditions, the world consumes about 100 million barrels per day. Production runs slightly above that, creating a small surplus preventing price shocks. Remove 20 million barrels per day, and you are not talking about a 20% price increase. You are talking about a supply shortage that sends prices vertical because remaining supply cannot cover demand. When supply drops below demand and there is no substitute, price rises until demand is destroyed. Destroyed means people stop driving, factories shut down, airlines cancel flights, economies contract. The number that destroys enough demand to balance the market when 20 million barrels per day are missing is not $120. It is somewhere between $180 and $220 per barrel based on historical supply shock analysis. The 1973 Arab oil embargo removed roughly 4 million barrels per day from the market, about 7% of global consumption. Oil prices quadrupled. The economic impact was a global recession lasting years. The Strait of Hormuz closure removes 5 times that volume. The proportional price impact, if the closure persists, pushes oil into the $200 range within 60 to 90 days. The assumption in Washington is that $200 oil punishes Iran more than the United States. Iran is an oil exporter. If oil prices spike, Iran should suffer because they cannot sell. America is an oil producer and consumer. High prices hurt consumers but benefit American oil companies. Net impact seems manageable. That assumption is wrong. Iran is not trying to sell oil right now. Iran is trying to collapse the American economy's ability to sustain a war, and $200 oil does that even if Iran earns zero revenue. The United States economy is built on cheap energy, not $30 per barrel oil, but predictable and affordable energy costs allowing consumption-driven growth. American GDP is 70% consumer spending. When energy costs spike, discretionary spending collapses. People still need gasoline to get to work. They still need to heat homes, but they stop going to restaurants. They stop buying new cars. They delay purchases, retail spending drops, corporate earnings fall, stock markets decline, the entire consumption engine seizes up. The numbers are clear. Every $10 per barrel increase in oil prices removes approximately $140 billion from U.S. consumer spending annually. We are already at 110, up from 65. That is a $45 increase, translating to roughly $630 billion in reduced consumer spending per year. If oil hits $200, the increase from pre-war baseline is $130 per barrel. That removes $1.89 trillion from consumer spending. For context, U.S. GDP is about $28 trillion. A $1.89 trillion reduction in consumer spending, which is 70% of GDP, creates a direct GDP contraction of roughly 4.7%. That is not a recession. That is economic depression. But it gets worse because energy costs cascade through the entire economy. Diesel fuels trucks moving goods. Those higher costs pass to consumers as higher prices for everything. Jet fuel costs spike. Airline tickets become unaffordable. Travel industry collapses. Heating oil and natural gas prices follow crude oil higher. Utility bills double or triple. Farmers face higher costs for fuel and fertilizer. Food prices spike. Every sector is energy dependent. When energy costs double or triple, margins evaporate and businesses fail. Now contrast that with Iran. Iran's economy has been under sanctions for 45 years. They have built an economic model that assumes they cannot access global markets. They are not trying to maximize oil revenue, they are trying to survive. And survival at $200 oil is easier for Iran than for America. Why? Iran's population has lived under economic pressure their entire modern existence. Inflation has been double digits for decades. Shortages are normal. The government controls prices and rations goods. The expectation is hardship. The Iranian government finances operations through domestic resource mobilization, printing money, and rationing. Unpleasant but survivable for a government fighting an existential war. The American government cannot print its way out of $200 oil. The Federal Reserve cannot lower energy prices. In fact, $200 oil creates inflation, forcing the Fed to hold rates high, worsening recession. This is stagflation, high inflation and contraction simultaneously. No policy tool fixes both. You raise rates to fight inflation, you deepen recession. You cut rates to help growth, you let inflation run. American policymakers faced this in the 1970s with $40 oil. They have no playbook for $200 oil. Gas prices follow crude oil prices. Every $1 increase in crude raises gasoline by 2.5 cents per gallon. At $110 crude, gas is 3.70 per gallon. If crude hits $200, gas hits $6 nationally. In California, gas exceeds $8. The average household drives 1,000 miles monthly at 25 mpg, spending $240 monthly on gasoline, up from $150. An extra $90 per month is $1,080 yearly. For a median household earning $75,000, that is 1.4% of gross income just on gasoline. Add higher food and utility prices. The median household loses 5 to 7% of purchasing power, and they vote. The political cost of $200 oil is immediate. Presidential approval ratings collapse. Congressional representatives face constituent rage. Pressure to end the war becomes overwhelming, not because Americans oppose just wars, but because economic pain is unsustainable. Iran knows this. Iranian strategy is not to win battles, but to impose economic costs exceeding America's political tolerance for pain. The mechanism is oil prices. We are 3 weeks into Operation Epic Fury. The U.S. has launched over 5,000 strikes. Iran's nuclear program is damaged but not destroyed. The Strait of Hormuz is still closed. If conflict continues another 60 days, oil prices continue climbing because the 20 million barrels per day through Hormuz are not returning, while Iranian anti-ship missiles and drones operate. The U.S. Navy cannot clear the strait without ground forces eliminating launch sites dispersed across hundreds of miles of Iranian coastline hidden in mountains. That requires ground invasion, Phase 3, with catastrophic costs. Washington's choice: accept $200 oil and economic depression, or deploy ground troops into Iranian mountains for a war lasting years. Both are losing options. That is the trap. This is asymmetric warfare, where one side controls a choke point and the other controls the reserve currency. The choke point side imposes costs by closing it. The reserve currency side suffers because its economy assumes cheap energy that reserve currency status was supposed to guarantee. When those assumptions break, the reserve currency becomes a liability because it allows deficits depending on global confidence. And confidence evaporates when America cannot secure supply lines. The United States produces 13 million barrels per day domestically. Does that insulate America from global price shocks? No. Oil is globally traded. American oil companies sell at global prices. If Brent crude is $200 in Europe and Asia, American oil sells for $200 in America. There is no cheap American oil for Americans when global prices are high. Domestic production creates supply sold at market rates. The only way to insulate American consumers from global oil prices is nationalizing the oil industry and mandating domestic sales below market rates. That is not happening. American consumers pay global prices regardless of domestic production. High oil prices benefit American oil producers short term, but those producers are part of the economy that collapses when consumers stop spending. If the broader economy enters depression because of $200 oil, demand falls, eventually crashing prices. But that crash happens after depression is underway. Oil companies might make windfall profits for 2 quarters, then face collapsing demand and a recession lasting years. The net effect is catastrophic. Iran does not care about oil company profits. The Iranian government is not maximizing revenue. It is winning a war by breaking American will, and American will breaks when voters demand an end to economic pain. Public support for foreign interventions collapses when gasoline prices spike. It happened in the 1970s. It happened in the 2000s when oil touched $147 per barrel in 2008. It will happen if oil hits $200 in 2026. The difference is $200 oil is not a brief spike. It is sustained as long as Hormuz remains closed, and the strait remains closed as long as Iran can threaten shipping, which they retain unless the United States commits to ground invasion, destroying those capabilities, which brings us full circle. Accept economic depression or invade, both losing options. $200 oil creates a global crisis, accelerating American alliance fracturing. Japan imports 75% energy through Hormuz. At $200 oil, Japan's economy collapses within months. Facing crisis, Tokyo must negotiate with Iran, China, anyone restoring energy access. American commitments become secondary to survival. South Korea faces the same. India, same. Europe, struggling post-Ukraine, faces another shock. Every American ally simultaneously faces catastrophe. Political pressure in every democracy. End the war. America becomes isolated not because allies disagree, but because they cannot survive the economic cost. That isolation is what Iran counts on, the collapse of political will across the alliance system through economic exhaustion. $200 oil delivers that. When I say Iran's strategy might be winning even as Iran gets bombed, this is what I mean. Military success is measured wrong. The question is not how many targets the U.S. destroys. The question is whether the United States can sustain cost longer than Iran can sustain destruction. At $200 oil, the answer is no. America's economy breaks before Iran's will. This is not defeatism, this is math. The carrying capacity of a consumption economy facing energy costs, destroying spending, is lower than a sanctioned economy that built resilience. Iran prepared for this war 20 years. The United States prepared to win quickly with firepower. Different preparations for different conflicts. When victory is determined by who endures pain longer, endurance beats firepower. The question is whether an off-ramp exists. Yes, but it requires acknowledging costs of continuing exceed benefits of winning. Hard for any government. But the alternative is continuing where oil hits $200, economy enters depression, allies defect, pressure for withdrawal becomes irresistible. At which point, you paid the cost and still lost. The rational choice is finding the off-ramp before $200 materializes. But rationality and war do not align. The real danger is not that $200 oil is inevitable, but that the pathway is paved with decisions making sense in isolation, but catastrophic in aggregate. Every additional week is another week closer. Once that number hits, economic consequences are not reversible with military victories. You cannot bomb your way out of depression caused by energy costs. The only solution is restoring supply. The only way to restore supply is ending the conflict that closed Hormuz. Iran wins by losing militarily but surviving economically long enough for America to conclude continuing is unsustainable. That is the scenario nobody in Washington wants to discuss, but it is what the data suggests is most likely if this conflict extends beyond 90 days.